Good morning to all. We welcome you to the Q3 earnings call of KEC. I will begin by outlining the key performance highlights for the quarter, provide insights into each of our business segments, and conclude with the outlook for the year. We have delivered a consolidated revenue growth of 14% for the quarter, with revenues surpassing rupees 5,000 crores. The growth has been primarily delivered by good performances in civil and the T&D businesses, both in India and international. With this, we have achieved a consolidated revenue growth of 17% for 9 months, which is in line with our guidance for the year. Our EBITDA margins continue to show an upward trajectory with an improvement every quarter. We have delivered an impressive growth in EBITDA of 54% in Q3 and 51% in 9 months. The EBITDA margins for Q3 have increased by a good 160 basis points, increasing from 4.6% in Q3 FY23 to 6.2% in Q3 FY24. We have also delivered a noteworthy growth in the bottom line. The PBT has grown by 11 times vis-a-vis Q3 last year and 3 times vis-a-vis 9 months last year. PAT has also grown by 6 times and 2 times in Q3 and 9 months respectively. The revenues and the margins could have been marginally better, but for the challenges in the supply chain and issues around the Red Sea. These challenges have resulted in a large increase in freight costs and also availability of vessels due to much longer turnaround time on most of the global shipping routes. In terms of order intake, our YTD order intake stands at approximately 13,000 crore with significant contributions from T&D and civil businesses. Notably, 25% of these orders are from supply of products such as towers, cables, hardware and poles. We are also being very selective on our order intake considering the working capital and the margin profile of our various businesses. Notwithstanding the same, we have a well-diversified and strong order book of over rupees 30,000 crores as on date. Additionally, we have a large L1 position of over rupees 8,000 crores primarily in the T&D business. With this, our order book plus L1 position stands at a record level of over rupees 38,000 crores, which gives us a visibility for the next 6 to 8 quarters. Our focus on cash flows and working capital management has started yielding results. With dedicated efforts, we have brought down our net working capital by 4 days to 129 days as of 31st December 23, vis-a-vis 133 days as on 30th September 23. Our net debt, including acceptances, has reached 6,045 crores as on 31st December, a reduction of rupees 300 crores vis-a-vis 30th September 23. This is despite a sequential increase in revenue of over rupees 500 crores. We expect continued improvements in working capital driven by better collections, commercial closure of projects, and a shift in the order book composition with a growing share of civil, T&D, and product supply business. We remain committed to further reducing debt levels by the end of the year. The positive trajectory of improvement in borrowing is also reflected in the reduction in interest cost for the quarter. The interest cost has been brought down to 3.3% of revenue for the quarter, a reduction of 70 basis points versus Q2 FY24. Now coming to the specific businesses. Our T&D business has achieved revenues of rupees 2,723 crores, a remarkable growth of 22% vis-a-vis Q3 last year. The growth has been backed by strong execution of projects across India and overseas, especially Middle East. The business continues to demonstrate strong momentum in order intake with YTD order inflows of over rupees 7,500 crores across India, Middle East, Africa, Europe, Australia and the Americas. In India, the business has secured multiple orders from PGCIL and repeat orders from state utilities. On the international front, the business has secured significant orders, especially in UAE through its Dubai subsidiary KEC EPC LLC. Leveraging our Dubai facility, we are strategically expanding our presence in the Middle East, resulting in a substantial order book and L1 position, which now stands at over 6,500 crores. Considering the sustained increase in tendering activities in the Middle East, we have undertaken a debottlenecking program for increasing our tower manufacturing capacity in Dubai facility by 20% at a nominal cost. This will enable us to meet the growing demands in the region and further consolidate our leadership in the Middle East. We continue to widen our presence in the tower supply business. During the quarter, we have secured our largest tower supply order from the United States of America. The momentum in a tower supply order, especially in North America, is indicative of the growing demand for our product offerings in the region. Our unexecuted order book and L1 from tower supply business now stands at over 2,500 crores, spanning across 6 continents. In SAE, I am happy to share that the business has delivered a positive PBT for the third consecutive quarter. Over the past year, the subsidiary has strategically focused exclusively on manufacturing operations, a decision that has resulted in consistent profitability in recent quarters. The business has a steady inflow of orders and has a healthy order book and L1 position of over rupees 1,300 crores, comprising of orders for supply of towers, hardware and poles, and engineering and testing of towers from the Americas. In Afghanistan, the progress on collection continues as we have realized an amount of 55 crores during the quarter. This brings the total collections post-regime change to a significant 320 crores. We continue to be in active discussions with the multilateral funding agencies for collection of the remaining receivables and are confident of realizing some more amount in quarter 4 and the balance in the coming quarters. The global demand for aluminum conductors has witnessed a substantial increase in recent years, driven by the growing emphasis on renewable energy and the need for new transmission lines worldwide. In line with our strategy of backward integration and to capitalize on the sustained demand, I'm pleased to share that we have decided to expand the product portfolio at our Vadodara cable plant by setting up a fully integrated manufacturing line for aluminum conductors. The capex requirement for this expansion is estimated to be around 60 crores, and the project is expected to be completed within the next few quarters. This development is anticipated to add to the competitiveness of our T&D business and also revenues of our cable SBU. As we look ahead, the business landscape continues to be promising. In the domestic market, we are witnessing substantial opportunities of over rupees 25,000 crores for T&D projects pertaining to renewable energy, including a large HVDC scheme across the states of Gujarat, Rajasthan, and Madhya Pradesh. Many of these tenders have already been floated and are expected to be awarded in the next few quarters. We expect another large HVDC project to be floated in the near future. We are also bidding for selective state utilities in India. Internationally, in addition to Middle East, we continue to actively explore opportunities across SAARC, Africa, CIS, and East Asia Pacific. Overall, our T&D business continues to experience a robust tender pipeline both domestically and internationally. With a record order book and L1 in T&D of over rupees 22,000 crores, we are confident of delivering a sustainable growth in this business. Our civil business has once again delivered an outstanding quarter, achieving revenues of rupees 1,100 crores, substantial growth of 30% vis-a-vis Q3 last year. The stellar performance is attributed to robust execution across all segments. The business continues to bolster its order book with YTD order inflows of over rupees 2,500 crores. During the quarter, the business has secured multiple orders L1 in diverse sectors, including metals and mining, residential and commercial buildings, defense, and water segment. Notably, our presence in the commercial building segment has expanded further with a prestigious order for a hybrid high-rise structure from a reputed real estate developer. We are now developing more than 50 high-rise buildings across India for marquee real estate developers. The business outlook remains healthy across segments. With a robust and diversified order book and L1 of over rupees 11,000 crores, we firmly believe that civil will continue to be a major growth driver for us. Our railway business has achieved a revenue of rupees 653 crores for the quarter, degrowing by 28%, impacting the margins and working capital of the business. In a recent development, our Honorable Prime Minister Shri Narendra Modi ji recently inaugurated the new Pandit Deen Dayal Upadhyaya Paupur Freight Corridor section in Uttar Pradesh. We are honored to have partnered with Siemens and DFCCIL to commission the signaling and telecommunication system for this prestigious project. In terms of order intake, the challenge continues owing to the increase in competition from Tier 2, Tier 3 EPC contractors and the shift in the clientele from railway PSUs to zonal railways. We continue to actively pursue select opportunities in India as well as international in the railways. In oil and gas pipelines, the business has delivered revenues of rupees 182 crores, a good growth of 15% vis-a-vis Q3 last year. The business has strengthened its order book by securing its second order for composite station works. We have also started exploring international opportunities and have been approved by a leading global energy company based in the Middle East. The business has a strong order book and L1 of over rupees 900 crores, comprising government and private players. We are confident of scaling up this business in the coming years. In our solar business, we are progressing well with the execution of our largest 600 megawatt solar project in Karnataka. We continue to bid actively for select opportunities in line with the sustained commitment of the government to promote renewable energy. We believe this business will help contribute to our growth going forward. Our cables business has achieved revenues of rupees 383 crores for the quarter. The business continues to deliver an improvement in margins on the back of an improved product mix. Notably, it has also achieved its highest ever profitability for the 9-month period of this year. In line with our strategy to enhance our portfolio of niche products and cater to emerging market segments, we have developed 2 new products, EV charging cables and green cables. These products are also in line with our commitment towards ESG and sustainability. Overall, we are pleased with our consistent revenue growth, improving trajectory of profitability and optimization of working capital. We generally have a positive outlook for all our business segments. We expect that tomorrow's budget will bring forth strategic measures and policies to foster growth and development in the infrastructure sector. With a robust order book plus L1 of over rupees 38,000 and a strong tender pipeline of over rupees 1,30,000 crores, notwithstanding the supply chain constraints, we are confident of maintaining our overall guidance on revenue of rupees 20,000 crores. Thank you, everyone. I'm open to take questions now.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and 1 to ask questions. The first question is from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Yes. Good morning, sir. And my first question is on this, on the domestic transmission opportunity. Given the fact that large tendering has happened in the last 9 months, or we haven't seen a small, it is converting into the order inflow for us. You did mention that you are L1 in roughly 7,000 crore. Is it fair to say that most of it is coming from the domestic market, domestic transmission market? And how do you see it going forward for the next 12 months?
So the L1 has got domestic as well as international, but I'll say a reasonably large amount is from domestic. And as you are aware, there has been a change in guard in our major client, and that has delayed some award of some orders which are in L1. I think we do expect that all of them should get converted into orders very quickly. Number 2 is clearly we are seeing a large potential at least in the next few quarters. There are at least 2 large HVDCs which are coming out. One is already been tendered out by Power Grid under TBCB, and on the renewable front, I think we have got at least 30-35 tenders to be quoted for transmission lines. So the potential in India clearly continues to be very good on this.
My second question is on the civil opportunity. So do you, given the fact that we are entering into a election mode, are we seeing a slowness in decision making and finalization of tenders, and do you expect that weakness to continue for a couple of quarters, especially domestic?
So as of now, we have not seen any major slowness in the orders or something, but clearly we will have some impact on the announcement of tenders and even on decision of some of the tenders, once the elections are announced. So once the Achar Sanhita comes into place, the tenders will not be opened or they will not be awarded. Also, during a 1 month or so of the election period, typically you find that the district administration and all others are busy with the election mode. So wherever you need ground support from the government officials, you may see some slowdown. But as far as private capex or private projects are concerned, and even some of the government projects where you don't need ground support from the administration, execution should not be impacted. But yes, there could be some impact on the announcement of tenders as well as decision of tenders, let's say starting March or something.
Okay, my last question is on this cable business. You said that you're going to expand into aluminum conductors. Is it fair to say that we are talking about AL59 conductors? That's where I think the CE has allowed all the EPC companies to put up to choose between ACSR or AL59. Is that a correct assumption?
So Mohit, we were manufacturing aluminum conductors even earlier, but at a very small quantity. So, that was more for our own business and for railway supplies, etc. However, looking at what's happening on the supply chain and the huge order book and tender pipeline, which we are saying our own order book, okay, we decided to do this, and obviously you're absolutely right. This will also have the capability to manufacture both AL59 and ACSR conductors.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you, Mohit.
Thank you. The next question is from the line of Amit Anwani from PL Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. My question again on the conductor side. So you did highlight it that there would be 60 crore capex. Just wanted to understand what is the capacity now, and will this be the strategic capacity expansion happening for 2-3 years, or this is just one of seeing the near-term trend and demand on the conductor side?
I think we'll have to wait and watch, Amit, as to what happens. The idea is obviously strategic, and also with our cable business, now reaching almost 1,700 crores. And this will more or less, if I do a merchant sale of this capacity, to add around 500 to 600 crores of revenue also. So right now it's more for internal consumption, because we have a large T&D order book and requirement of AL59 and ACSR. So as of now, we don't intend to sell in the market, but depending upon what happens, and this is not a high cost also, 60 crores, and I said that turnover 500 to 600 crores. So, from that point of view, we'll see what is to be done. I think it's a little bit early on that side, but today, as I said, it's for our internal consumption.
Right. The next question on the order intake. So we are at roughly about 13,000 crore YTD, and we have been guiding 23 to 25,000 crore. Just wanted to understand, are we sticking to that? And second thing is, despite so much robustness, any sense you're getting from the domestic market, though we are seeing a strong pipeline, that there could be some risk to intake or spillover happening from next year onwards?
So clearly, meeting the guidance of 23-24,000 is going to be a bit of a challenge, because we are right now at 13,000. We have 8,000 crores of L1. So unless we are able to get some more projects very quickly now and get them before March, it's a slight challenge. I'm not seeing as a major challenge, but maybe a little bit here and there. But I think I want to add one thing, Amit, is that if you look at our order intake and all that, a large part of the order intake has been from transmission and especially PGCIL, where the execution time is around 15 months. So the order book to revenue ratio in our case would be significantly controlled, unlike other infra players where the ratios are beyond 2 and 3 and all. For us, the ratio has been between, and I don't expect it to be beyond more than 1.2 or 1.3 times. And especially that 20% of our revenues are coming from supply orders. So if you take that out, we should be having a revenue of 18,000-19,000 crores or something like that next year. And so 25,000 or to 27,000 crore order book also is okay. So would we want to have a larger order book? Yes, we would like to have a larger order book, but is it okay for our planned growth for next year? I think our current order book plus L1 is also good enough for our numbers.
Sure. So my last question on the margin. So we saw the sequential margin ramp up. So just wanted to understand segment-wise, if you would like to highlight, and now civil is the larger part of the business. How is the margin ramp up we are expecting in next 6 to 12 months across segments? We saw domestic T&D was also under pressure with respect to margin. So just wanted to understand your view segment-wise, where we are seeing the major margin ramp up in next 12 months.
Typically, we don't give segment-wise margins on this, but let me add one thing, that domestic T&D is right now in a very sweet spot. and I think they will have pretty good margins. Okay? I can only say that maybe closer to a double digit or something, but the domestic T&D, I think, is seeing one of the best years, at least I have seen in my last 22, 23 years with this industry. But domestic T&D is really doing very well. And I think international is also picking up. We had issues in international because of fixed price contracts and all that. Now that I think almost all are hedged, etc. So international will also do well. Civil, we are generally seeing a decent margin, slightly lower than what we would want them to do. Okay. But I think the margins and the working capital in civil are doing well. Railways continue to be some challenge on account of the delays what we are seeing because of block availability and other issues. Cable, I already said that they are one of the best margins. Yeah. Thank you, Amit.
Great, sir. Thank you. All the best.
Thank you. The next question is from the line of Bhumika Nair from DAM Capital. Please go ahead.
Yes, sir. Thank you very much for the opportunity. So just continuing on the question on margins, you did mention that some of these international T&D projects which have been a strain factor are coming to an end. So when do we start seeing this legacy orders of fixed price kind of, completing? And when do we start seeing the current orders kind of reflecting in terms of an improved margin profile?
So, Bhumika, I think improved margin profile has started. If you look at last few quarters, we have been improving, bit by bit, not what we or you would have loved to see, but that's not the way it has happened. But I think we are improving. New margins are starting to kick in. Old ones, I'll say more or less on the domestic side, we are through with all of them. Okay, international, we still have one or two orders which we are now in the midst of concluding. So I think by Q1 next year, all the legacy orders should be completely out of our system. Okay.
Okay. And how is, you did speak about, the behavior that we're seeing in the domestic T&D. Similarly, if you can also touch upon the international when we are bidding for orders and getting orders, how is the bid margins kind of trending? Is that also seeing like a double-digit kind of a thing which can possibly reflect into our actual margins, into the second half of 25-26, where these margins are starting to reflect?
Difficult to generalize about international because I think each country has got its own challenges So let's take something like Saudi. And, interestingly, what we heard L&T talking about, the Saudi predominance and all that. So today, if you look at our international market, it is predominantly, I think, 2 or 3 countries. So beyond Saudi, we are doing very well in UAE also, and to an extent in Oman, I'll say, and some orders in Kuwait. So those are countries where the competition is relatively less because their pre-qualification and the criteria which they follow is pretty tight. Okay. Hardly any, if you look at India, hardly 2 or 3 companies from India are there in that market.
Right.
Africa has been a bit of a challenge, but I'll say this quarter onwards, or maybe last couple of months, we started seeing new tenders coming in. And we are already L1 in a very large tender in Africa, which is part of the L1 which we are seeing. Okay. The brighter spot seems to be United States, North America, and a little bit of, I'll say, LATAM also, where we are seeing a lot of inquiries for supplies. And as I said in my earlier part, that we have got some very large orders, and we will still have very large inquiries both from US market, Chile, Colombia, and also from Australia. So, which is why we are trying to expand our Dubai factory also. So I think overall, the markets look good. Margin would actually depend, Bhumika, on individual orders. What is the competition, what is the complexity, etc., rather than generalizing. Okay.
Right. Understood, sir. And so similarly for civil, because, we've seen the 9 months YOY kind of being slightly down versus last year. So there are the margins kind of holding on. Is there any improvement? And I do understand that, relatively the margins are lower, but, the working capital is also much better out there. So if you can just comment on that aspect as well. And lastly, I just want to also touch upon the working capital, which has kind of seen an improvement in the current quarter as also a debt reduction. So, what are we looking as the year ends in the next quarter or so? How should we look at this kind of further improvement or, any comments on that aspect as well?
So let me take the first two questions that Rajiv can answer on the working capital. So as far as civil is concerned, I think, yes, there has been a slight, I'll say, a slowdown in the order intake. We were expecting a lot more orders looking at the growth. But I think, Bhumika, what happened was that somewhere with T&D doing so well, we also upped our gate in civil, saying, I need one or two growth engines, and if T&D is firing where I'll say I have a better control on everything. Okay, and today T&D is virtually almost 60% of our order book. Okay. So we did say that on civil we became a lot more selective on what we wanted to do and also at what levels we wanted to do. So which is what reflection you can see on the order intake of civil as well as railways, because in both the cases we really increased our threshold limits. Okay. That's why you are seeing. But in any case, my order book plus L1 in civil is even today at 11,000 crores.
Yes.
Okay.
Yes.
So, and I don't have any large, 5-year, 4-year orders and all that. So most of these orders would sort of get executed over the next 15 to 18 months. Okay. So civil, we are still expecting that we'll grow by at least 25 to 30% next year also, on top of what we are growing. Yeah. So that's on the civil. What was your second part? Sorry.
On the margins and working capital of civil also, sir. That was actually the question.
Margins, I think I generally covered in my earlier part where we briefed about all the books. But today, I think clearly,
So Bhumika, on the working capital front, as you are aware, we are focusing a lot on the working capital, and this quarter we have been able to reduce debt by about 300 crore. And that has helped us to reduce the NWC days by 4 days from the previous quarter. So we are at 129 days. And we are expecting a lot of collection to happen in quarter 4. And our estimate is that, by end of this year, we should reduce the NWC days to about 110 days or so. So last year we were at about 118 days. So from there will be a reduction of further 8 days on the NWC front. In terms of the, debt profile, I think we should be closer to about 5,200 crore or so, including the interest-bearing acceptances. And that's where, with the 15-16% growth on the revenue side, we will be able to generally maintain our debt levels at the same level as last year.
Okay. That's quite encouraging, sir. I'll come back in the question queue. Wishing you all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Parikshit Kanpal from HDFC Securities. Please go ahead.
Yeah, sir. Hi. Congratulations on a decent quarter.
Thank you.
I heard your overall commentary on the margins. So just on the standalone margins, when do we expect that to improve from here on? Because there we have been seeing some pain there for many quarters now. So in our overall trajectory of moving to high single-digit margins by FY26, so how do we see standalone margins playing out?
So to me, standalone should start improving from this quarter itself, because now the India T&D piece is going to start kicking in. Okay. So I think from this quarter onwards, quarter on quarter, you'll start seeing an improvement in the standalone. There's no question about it. See, if you look at the last 1 year, you are aware that we had this TBCB issues where we had, the metal prices and also all that has been closed. So now you'll definitely see the margins improving in standalone, both in T&D and civil.
Okay. Just on the Dubai factory, so if you can just, sorry I missed that number, you spoke about order book there. So what is the order book? What was the 9-month revenue and EBITDA from that entity?
I don't think we spoke about the order book on Dubai. What we said was the order book plus L1 in Middle East is around 6,500 crores. We also said that we are expanding capacity by 20% in the Dubai plant at a very nominal debottlenecking cost and all that.
Okay. And what will be the revenue and EBITDA from the entity in the 9 months?
So Dubai, we have got two different entities. One is the supply entity which runs the plant, and then we have an EPC entity. So all our orders in UAE are now under that entity. We call it Dubai EPC LLC. I don't have the numbers for Dubai EPC LLC, but between the two of them, I think we are around 1,500 crores of revenue.
And EBITDA will be how much?
Maybe around close to 9-10%.
Okay. Because when we separate the standalone and console, I mean, the numbers on EBITDA looks really high. So I was wondering, like, which entity. So largely the Dubai entity which is contributing this, right?
Well, Parikshit, it is a Dubai entity, and I also mentioned that SAE has been doing well. It's a positive PBT with the high interest rates in Brazil. So so the EBITDA there is reasonably good also. So it's a combination of both Dubai as well as Brazil.
Okay. So what would be the 9-month EBITDA for SAE now?
It would be similar to a 9-10%, you know.
Okay, 9-10% EBITDA. So we are back to that old ways of doing EBITDA.
Absolutely.
Okay.
Absolutely.
Just on the residential business, so you did say that you have about 50 high-rises you are executing across India now. So of the total order book, what will be the private real estate? And in the past, we have had, now the cycle is doing good, but in the past, we have seen very, very focused residential or building EPC players exiting the private real estate and focusing more on government side. So how are we looking to mitigate the risk in case there is a downturn in the cycle in the coming years? So how do we do the risk assessment here while bidding? So what kind of clientele we had, what clientele we are targeting here so that no major risk comes on us?
So as far as private residential is concerned, Parikshit, we are working with, I think, 4 or 5 of the top developers. I don't think we have more than 5 clients in the private residential. Okay. Names I would not like to give here, but you can take it from Abhishek. So those are there. If you look at the public sector, I'll say residential as well as sort of commercial, because office blocks and everything is there in that. So we have a few projects with the defense authorities where we are doing at least, I think, 4 or 5 projects with defense. Then we have got a couple of more commercial projects which are with private equities and the bigger reputed houses. And then we are having, I think, 4 or 5 data centers, which are again with big marquee names. So that's the way broadly the risk profile of the clientele for, I'll say, residential and commercial is there.
And what will be the total order book from the building segment and this entire piece of which you just highlighted?
I don't have the number, but I think it should be close to around 3,000 crores. If you add residential, commercial, and data centers and all together, we should be 3,000 or more. Maybe Abhishek can do the exact number, but I think that's a ballpark number.
And on an individual basis, how much is your qualification now on your books, like for building segments, especially the government buildings? Because we did see some large tenders coming in for station redevelopment and all. So how are you placed there to build those kind of tenders, and what will be your individual qualification on the government side?
So Parikshit, what happens here is that the government tenders for buildings and all come from different authorities. It's not like, like we have in T&D, we have one power grid. So there, you can very clearly define your PQ. Here it is difficult. With some people, you may have 500 crores. With some people, you may have 1,000 crores. Very, very difficult to today quantify as to what you can do. And obviously, with private, you don't need a PQ that way. I think the tallest we are doing right now is a few buildings of 40 story and above. Around 40 story is what we have got, a few buildings. So that will help us in private. Public is different. Okay, I think the biggest order we have in public on this is 550 crores or 600 crores from one of the state governments.
Okay. And just the last question, sir. I mean, you did mention about strong ordering in T&D, then TBCB, HVDC, so everything now falling in place. 25,000 crores, I think you spoke about the total bid pipeline. So just one question. Now, when on the other hand, we are seeing this on the supply chain side, this equipment providers, the transformer substations and all, they're also talking about shortage of supply coming in. So in this kind of a scenario where there could be potentially price inflation coming in or price hikes coming in the equipment value chain, so how are you bidding now when you tender as a composite package on the EPC side, so that our margins won't suffer if there is some undue increase in prices because of shortage of supply?
So typically what happens, Parikshit, is there are 2 types of risk in the price part what you talked about. One is on the substation side and one is on the transmission side. So transmission is basically conductors where you see a short supply, which is, I'll say, slightly easing. It's not easing, but it's better than before, I can say that much. So there, the moment you're L1, you go and hedge your aluminum exposure on the LME or with the vendor. So there is now zero price risk on that. As far as items like, let's say, a GIS and all this is concerned, typically we have been dealing with most of the vendors who give you a fixed price. You may have small exposure in copper, which you can hedge, in this way. So I don't see a price risk on what we are doing. Supply risk is always there, saying whether it gets delayed or not. But typically what happens is with a client like us, and today we are, I think, probably the largest substation contractor in the country. We do sign up on the delivery periods before we bid with the vendor. So I don't think we are facing a significant delay. Yes, there are delays of maybe one quarter, equipment moving from one quarter to the other quarter. So I don't think we are today worried about it. In fact, to me, it's a better opportunity for us because with our relationship with all the OEMs, etc., we do get preference in, I'll say, at least in supplies, if not in prices, and that's actually adding to our competitiveness.
Okay. Thank you, sir. Wish you the best.
Thanks, Parikshit.
Thank you. The next question is from the line of Vaibhav Shah from JM Financial Limited. Please go ahead.
Yeah. Sir, what would be the outstanding debt in the SAE entity?
Rajiv? 400 crores. Around 400 crores.
Okay. And what would be the interest cost?
12%. 12%. Yeah, roughly around 12%.
So we expect it to further come down or should be stable around these levels?
I don't think the interest rates are coming down. Yeah. Obviously, to the extent we make money there, the debt itself will come down gradually. But interest rates, I think last 1 year, the Brazilian Central Bank brought it down by 25 or 50 basis points last year. After that, they have been quiet. So unless and until the global interest rates come down, I honestly, next 2 quarters, I don't see the interest rates coming down in Brazil. No.
Okay. And sir, we have been PBT positive for first 3 quarters, right?
Sorry?
Yeah. We have been PBT positive for all the 3 quarters, right?
Yes.
Yeah. And sir, on console level, we had guided for margin improvement in second half. So we were targeting around 8% in second half and around 7% for the whole year. So given the weaker margins Q3, so do we reduce the guidance for the whole year?
I think we will have to. We still don't have the numbers. We are looking at what is going to happen in Q4. But I think that margin guidance looks difficult to achieve today, very, very honestly. But I don't think it is going to be significantly different. Okay, from 7%, whether it will be 20 basis points, 25, 30. I don't think we are saying that 7% will become 5% or 5. No, not that way. So there will be some downward. This will also depend upon the supply chain part of it. Are we able to get some more supplies for some more profitable orders, etc., where the margins can be higher? So it's slightly difficult to put a number, but yes, it will be in a way a little bit lower than what we were talking.
But there will be a significant improvement on quarter-on-quarter basis in fourth quarter.
It will definitely significant improvement quarter-on-quarter. Also, the interest costs will come down. So on the PBT side, you will see improvement happening.
Okay. Thank you, sir. Those are my questions.
Thanks. Thank you so much.
Thank you. The next question is from the line of Bala Subramanian from Arihant Capital. Please go ahead.
Hello, sir. Good morning, sir. Thank you so much for taking my question. So I just wanted to understand what are the challenges we are facing on order intaking. We have guided around 20,000 to 25,000 order intake, but till now we have achieved around 12,850 crores. Just want to understand which are the sectors we are facing issue, and is there any specific reason we are facing challenges because of elections? These are my first questions, sir.
So on the order intake, we are at 12,000 or let's say close to 13,000 plus 8,000 of L1. So, in that way, we should be at 2021. As I said, we may not be reaching 24, 25. Also, because we very clearly have become a lot more selective on the order intake, especially because again, we are getting a lot of orders. So we deliberately slowed down, especially on the railways where we are seeing a lot of uncertainty in times of execution. And civil, where we realize that, it's not the numbers, the private capex is not happening in the way we were looking at it. But I still, as I said, I don't see a challenge on that because we have a large order book, more than enough for meeting our guidance for the next year.
Got it, sir. So now on that, we are doing deep bottlenecking in Dubai facilities. Like, what is the facility capacity and how much capex we are doing, and what is the asset turn for those capex?
So we are currently at 50,000 tons per annum, so we are expanding it to 60,000. That's the cost is hardly less than 10 crores.
Okay, sir. Okay.
Thank you.
Thank you, sir.
Thank you.
Thank you. Participants who wishes to ask questions may please press star and one now. The next question is from the line of Vinod from BOB Capital Markets. Please go ahead.
Yeah, so thanks for the opportunity. You just mentioned in your opening remarks that the clientele is shifting in railways from rail PSUs to zonal railways. So do you think that will impact our margins and working capital in some sense?
You know, it has already impacted, okay, and we are seeing a significant problem in the margins as well as working capital, because what is happening is that, earlier you were dealing with, in a way, I'll say, professional managers whose job was to execute projects. You are project manager, program managers, etc. Now one is the number of clients has multiplied. I think there are 17 or 18 divisions in the railways. So you're sort of dealing with 17, 18 different clients where there's a lot of movement of people from one railway to the other, etc. And they are not the people, they are very good at running railways. Okay. Are they very good at running projects is something which has been, a bit of a problem. Second part is the railways also change the railways also change the numbers from the project type from BOQ to EPC all of a sudden. So one is you got people who are not conversant with running large projects, and then you also change the type of the project from BOQ to EPC. So that has created a major disruption for all the EPC players, and you can check with any one of them. I think all the large EPC players have been facing a lot of disruption because of this. So unless and until either these things get reversed or the divisional railways become much more expert in handling EPC contracts, design-related issues, etc., that there will be continued disruption for some more time, at least in the railway EPC orders.
Okay. The second question I had was on T&D. You yourself mentioned that it's one of the best years for T&D in the last 20 years. And given the, probably increased mix of T&D in KEC next, say, couple of years, you see KEC going back to that old double-digit margins. So, I mean, if you look at KEC a decade back, when we were purely T&D, you used to make 11-12% kind of margins.
So I think that's our hope and wish also, that we go back to double-digit margin. But I think the way things are happening, I think at least in T&D, probably in H2 next year, we should be, reaching a double-digit margin. As I said to one of the questions earlier, that, our legacy orders and all that will be closed by Q1. I'm just taking some time, an extra quarter there. So I do think that by H2 we should be back to double-digit in T&D.
Okay. Finally, Vimal, a macro question. Are you seeing the return of the sellers market given the way the capex cycle is behaving? So, I mean, basically in terms of, say, better customer advances and lesser competition. Are you seeing that happening in this space now?
So I think for a particular size of the projects, we are seeing that happening. Okay. And particular type. Like I'll give a simple example. In railways, if you look at new lines and all that, it's not happening because there are too many road players coming into railways. Okay. But if you look at, let's say, T&D, where there are very large projects, like I remember 6 months back, we got a project of almost 900 crores from Power Grid. Now, for projects of that size and etc., it's clearly turning. I'll not say sellers market, but I think the competition is significantly below what we used to see at 10 and 12 and 14 players. So that's come down. Similarly is the position in, I'll say, in Middle East also, especially UAE, Oman, Saudi, etc., where the competition has significantly come down because of the volume of business.
Okay. So So we still probably some time away because from that stage where, you probably can command a much better advance, customer advance and those kind of
Yeah, customer advances is something which depends upon, again, contract to contract. Okay? So most of the international projects will have an advance. Even now, India also, I think most of the projects now have a customer advance.
Okay. But is it quantum going up? Because in the previous cycle, I recall customers were even willing to pay 15-20% as advance.
So that is happening, especially on the private CapEx side, where you can go and negotiate with the clients. Okay? In all the public sector, et cetera, because it's a tender specification, you're not able to change. We are also seeing this improving, especially when it's multilateral funded in Africa and all that, most of the projects have 15-20% advance. But Middle East and India would typically be around 10%.
Okay. Thanks, Vimal. Those would be my questions. Thank you.
Thank you. Thanks a lot.
Thank you. Ladies and gentlemen, that was the last question. I would now hand the conference over to Mr. Vimal Kejriwal for his closing comments. Over to you, sir.
Thanks, Michelle. And thank you everyone for your continued interest in KEC. Thank you very much.
Thank you, members of the management. On behalf of KEC International, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.